Hi, this is Ferre and Swenson of TaxSaleSupport.com with the Tax Sale Secrets weekly update for the week of June 9th.
Yeah, exactly. We want to thank y'all for watching this video and apologize. We've missed the last month or so, but we were actually updating and redoing our program.
Yeah, we were on a deadline there to get it done, so it was a great thing. But we were pretty crazy busy there for about a month, so it's actually nice to get back into it.
Yeah, so every Friday we'll go ahead and put out a new video. We'll just go over news and announcements, and then each week we like to go over a different topic. Essentially, we want to talk about different types of tax sale investing techniques and topics that are interesting to you. If you guys have any suggestions, feel free to go down the comment section and let us know.
Yeah. Now, in terms of news and announcements, on June 30th, that's a Saturday. That's our Saturday morning online workshop, which we do. That's at 10 o'clock Mountain Time, which is 9 o'clock Pacific and 12 o'clock Eastern.
Yeah, yeah, exactly. If you want to register for it, just go ahead and click down in the description section, and you can go ahead and click on the link to register.
Excellent. And also, you can always join the membership program if you'd like to learn more. We basically have that program set up. You can cancel it anytime, so it's not a committed program essentially. We wanted it to be affordable, and so we have it set up like that. I think people can be tentative about it because they sign up for different things and they're always let down. But if anything, you're probably going to be overwhelmed by how much stuff is at your disposal there.
Yeah, exactly. We offer a 30-day money-back guarantee with it, and so we think that it has more to offer, especially for the value, than really anything else you can find.
Yeah, and for the topic for tonight, what we're going to be talking about is really about market value versus wholesale value. And when it comes to property values, there's actually a lot of different types of values that you're going to come across. I mean, there are many different terms here. We tried to cover the majority of the terms that we hear on a regular basis right here, and we have a lot of them there. But really, with all these values here, I can see why it's something that sometimes confuses people.
Yeah, exactly. Each one of these values is essentially going to be a different way in a different process to essentially value the same piece of real estate. So we could be looking at a single-family home, and every single one of these is essentially going to have a assessed value, an appraised value, the wholesale value. And so learning what these different value types are, when you hear them, you're going to understand them.
Yeah, and so I think it's good to understand what each one of these are. When it comes to our time investing, the primary ones that we use the most really are assessed value, and that's because we're whether we're referring to it as assessed value or the county's estimated market value or whatever it is, it's normally the first thing that we use. I think from the perspective of tax sale investors, but also wholesale value and then the market value.
Yeah, exactly. Each one of these is essentially going to be the like Shade said, the value system that we're going to use the most. When it comes to assessed value, that's going to be the first value that we see. Essentially, we're going to be using assessed value and market value to determine the bid to value ratio. We're going to use that wholesale value when we're looking to sell the property. And so we're going to go through and talk about each one of these.
Yeah. In fact, the assessed value really it is the value that's placed by the county, and that's going to be the local tax assessor. But what you also need to understand is that in some states, they have different office or different terms for essentially kind of the same office. In some place, they call it the county appraiser.
Yeah.
But it's essentially the same thing. And the value that we've got there is given to all the property for the property tax system. But it doesn't necessarily mean that you would use that value to, let's say, sell the house for full value. Full value actually has a meaning in and of itself. The assessed value normally is going to be just a little bit under it. But what's nice though is it's the first thing we can use there to do that bid to value ratio. So we can immediately see on the value if the numbers work or not. If it's 50%, we obviously know that's something wrong with that property, and we're probably not going to pursue it.
Yeah. I mean, essentially, it's the tax assessed value, and so this has to do with the property taxes. They use a formula to determine exactly how much the assessed value is, but it's usually going to be pretty close to the market value. At least it's going to give us an idea of the value of the property. Now, like Shade said, the assessed value can go, below that. It can sometimes go above that. Sometimes the assessed value can be, even more than 20%, maybe 30 or 40% below. We can see that in some situations, especially if the market value is going up in that area.
Yeah. In fact, that's why it really is a good idea to, not have the assessed value be your only, value that you're going to grab on the property. Just because you can have an area where, property values are quite a bit, quite a bit higher, and it would change the numbers dramatically if you're using the actual market value, on the property versus, the assessed value. So. But in many cases, though, it is good enough though to at least be able to spot out good deals.
Yeah, well, essentially, if we see the assessed value and it looks good, then we're going to go research that property to find out what the market value is.
Yeah, really, it is a fairly linear process there in terms of the thinking on it. Now, the wholesale value is one that we get questions about sometimes, and the wholesale value is an important value to understand, because if you're trying to buy a tax deed and turn around and sell it as is, then wholesale value is what you're going to be dealing with. And the wholesale value is basically the price that investors are willing to pay for the property as is. Okay, meaning that you're going to be conveying title through like a quitclaim deed or some transferable deed like that, and not through a warranty deed, as is the other case.
Yeah, with wholesale value, essentially, you're usually looking to sell a property in a short period of time. So you're willing to sell it where you're making a profit. So, under 50% of market value, well, if you're buying the property for 10 to 20% of the value, you sell it for 50%, you're still making a good return on the profit, and there's still enough room in that deal for the investor or the buyer to take the property at that discount. Also, one thing that's going to separate wholesale value from market value is essentially going to be the deed type. So, with this type of property, because we're doing a tax deed, or we're quit claiming over to somebody else, we're giving our ownership to them. Because of that, that's essentially going to, cause us to sell it for less.
Yeah. Now, when you're looking at it, that 50% number is really just a rough estimate, and what it really comes down to is what buyers are willing to pay. And so, it can vary really. I don't know that it's a hard set number. More than anything, it depends on how long you're willing to wait to find a buyer. There are a lot of different things that can play into that. But you do need to go into with the understanding that you're selling it at a discounted, right? Because what it is essentially a clouded title. It is, a title that has some kind of clouded title. Is kind of like saying a salvage title on a car. But the difference with real estate is that you can change that title into a clean title again, which would be a warranty deed, which is really where we're talking about with market value. Okay, now the market value is the value that the property would most likely sell at the current, during the current market conditions. So we can kind of determine that, the market value through comps. Really, that's kind of essentially what determines it for us is the comps.
Yeah, exactly. It's something we teach our members is how to do a comparative market analysis. This is going to be essential to you being a tax sale investor, because you need to be able to go in there and determine the value of property without needing an agent or somebody else to do it. And it's pretty simple to do once you understand how to do it. And so essentially, you're going to go look for similar properties that have sold, that are currently for sale, to help give you a good idea of what properties are essentially selling for in the area. Then from there, you can really determine what the value of the property is. And so when we're investigating a property, we're going to check, even if we plan on selling it for wholesale value, to help us determine what the wholesale value is, we're going to first determine out what the market value is.
Yeah, exactly. In fact, we have to know what the market value is really in most cases in order to determine a wholesale value. Otherwise, we're going to end up missing the mark. And that's because once we can determine, what the market value is, from there we can have, a proper selling price. But if we don't know what it is, then you basically can't get one without the other. Now, some things about the market value of the property is that it is a transfer that's going to happen through a warranty deed, meaning that it will qualify for title insurance.
Yeah.
Okay. That's basically, for people that don't know, title insurance is something that lenders require for most transactions that are being lended on.
Yeah, essentially what the title insurance is it's insuring the warranty deed. And so to be able to do that, when we're buying these properties, 99% of the time you're getting a tax deed or a land patent or a limited warranty deed or something like that. It's not going to be a full warranty deed. And so because of that, if we want to sell the property with a full warranty deed, then we're going to need to go through quiet title action. Essentially, this is a court process where we take the property before the judge and notify all the party owners, letting them know that we're essentially, getting a warranty deed. And at that point, then we can sell it through a realtor. We can get qualified for title insurance. You can, in some ways, get title insurance on tax deed properties, depending on the property. And then also there's services out there you can do it as well. But if you're not going to use something like that, then essentially you're going to need to go through the quiet title action to get a warranty deed. That way you can sell it for full market value. So you're essentially selling it for top price.
Yeah, for top price, that is basically, that is what market really is the top price, which is what the market's willing to pay for the property, at that time. And you can usually get a pretty good estimate of that market price just by what's selling. So, what's important to note here, though, is that you have options when it comes to what you're going to do with the property. And, it doesn't have to, you basically don't have to sell it, through at market value, because there are a lot of people out there that are happy to buy property at a discount, because, they don't mind that really, especially if you're talking about people, either investors or people that are planning on holding on to the property. If they're planning on holding on to the property, they love, to be able to buy property at wholesale,
Sure.
at wholesale prices, because it's a big discount, and they don't care about the title on it, because they're planning on paying cash.
Yeah, and they own the property outright, and as long as there's not liens on it, which that's what's nice about tax sale foreclosures, is it eliminates those liens, then essentially, they can go ahead and hold on to the property. So let's say you buy a nice building lot and you end up selling it to the neighbor. Well, you would go ahead and sell it to them for wholesale value, a discount value. You may even sell it for a little bit lower than wholesale value, or essentially to sell it to the neighbor.
Yeah, whatever it takes to get interest in the property, maybe.
Yeah, and so at that point, you're going to go ahead and give them a quitclaim deed, and they can go ahead and hold on to that property. And now they own this additional property next to their home, and they picked it up for cash for a small amount, but because you were able to pick it up from the tax sale or an over-the-counter sale or something like that, you paid 5 or 10 cents on the dollar, and were able to turn around and sell it for maybe 30 or 40 cents on the dollar, and you made a good return. And the property owner was happy because they were able to get a property for way below market value. So it's looking at a car. Let's say you look at a car and it needs new tires, but besides that, it's a $10,000 car and you can buy it for $2,000. Yeah, we can put some new tires on it, or we'll drive it as is, and then when it needs new tires, we'll get it essentially.
Yeah. Now, one last thing here to talk about is really your exit strategy and how it kind of plays into those two value amounts. Either the wholesale or market value, and then of course the assessed. When it comes to the property, really should have a plan with each property on what you're going to do, and it should be based on the property itself. In other words, it's kind of tough to have one plan with the property saying, okay, well, I'm going to sell everything that I buy, within 3 months, or try to sell it within 3 months, because you might have plenty of properties where it would make a lot more sense to pursue other methods. Like on some properties, it might very well be worth taking it through quiet title, even if it's going to cost a little bit of money, because it's going to make that much more.
Yeah, I mean, even if you had to pay $2 or $3 grand in some scenario to go through quiet title, but doing it, took the property that you're going to sell from 50 grand to 100 grand worth of profit. Well, then it's better to sit on the property for 3 or 4 months, add some paint, something like that, and sell it for top dollar.
Yeah, exactly. And really, when you're looking at properties, you should be able to kind of determine which one is going to be best, with the property. In other words, if you identify a property that you believe you're going to wholesale, then you should be able to identify a market value for it and have an idea of what you could sell it for at auction, and then you can place your maximum bid from there. So that you are basically watching your profit margins. Either that, or else you can bid at very low rates that are way under what the margins are that are acceptable to you.
Yeah, exactly.
So it's important to know with each property how you're going to plan on getting rid of it. Especially if you want to sell stuff quickly. If you're planning on hanging on to things, then even with those properties, you should have a plan and an idea on how you might monetize them.
Yeah, definitely.
So, well, thanks for joining us here for the weekly update. If you want any more information, you can always catch us on either the websites or on Facebook.
Yeah, definitely. Don't forget to subscribe, and please like the video. We appreciate it.
Thank you.